Gold and silver just took a hit. Here's what happens next. In 1980, silver crashed 31% in a single day. It was the fastest collapse in the history of precious metals, and almost nobody saw it coming until it was already happening. Now, in 2026, something eerily similar is playing out. Silver just recorded its sharpest intraday decline since October, and gold posted its worst single-day drop in months. And the strange part isn't that it happened. The strange part is what happened right before it, a pattern almost identical to 4 other moments in market history, each one followed by a very specific, very predictable next move. What if the real warning sign in today's gold and silver market isn't the price drop you just watched happen, but a much quieter signal buried underneath it? A signal that history says shows up right before the next big move, and almost no one is watching for it. By the end of this video, you'll understand exactly why gold and silver fell, what the data says happens next, the 3 historical parallels that matter most right now, and the specific signals professional traders are watching in the weeks ahead. Because right now, in July 2026, this market is standing at a fork, and the direction it takes from here could shape portfolios for years. Let's start with what actually happened, because the headlines have been messy. Gold and silver had one of the most explosive rallies in modern history through 2025. Gold surged 66%. Silver did something almost unheard of. It climbed 135% in a single year. Then in January 2026, both metals kept pushing to fresh records, with gold briefly touching over $5,000 an ounce, and silver breaking past $100 for the first time ever. And then, almost overnight, it reversed. By the end of January, silver suffered its worst single-day crash since 1980. Gold has been sliding on and off ever since, and as of early July 2026, spot gold slipped below the $4,000 mark, while silver dropped sharply to around $57 an ounce. Year to date, gold is down almost 8%, and silver has shed more than 20% of its value. So the question everyone's asking is simple. Is this the end of the precious metals rally, or just a pause before the next leg up? To answer that, we need to understand why this drop happened in the first place. And the real cause isn't what most headlines are telling you. Most investors focus on the obvious explanation. Prices went up too fast, so they came back down. And that's part of the story, but it's not the real story. Here's what's actually driving this. Back in late December 2025, the exchange that oversees silver futures trading quietly raised the amount of money traders needed to hold their positions, the margin requirement. The initial margin on silver contracts jumped to $25,000 per contract. That sounds like a technical detail. It isn't. It's a trigger. When margin requirements rise that fast, smaller traders, the ones without deep pockets, get forced to either add more cash immediately or have their positions liquidated automatically. That's exactly what happened. A wave of forced selling hit the market, and it snowballed. But that's only part of the story. The bigger force sitting underneath all of this is the Federal Reserve. Markets have been pricing in the possibility of the Fed raising interest rates instead of cutting them, something almost nobody expected a year ago. Strategists at Macquarie pointed out that all eyes are now on inflation, and whether the Fed will tighten policy to keep prices under control. Higher interest rates make gold and silver less attractive, because metals don't pay interest, cash and bonds suddenly do. Then add a strong US dollar into the mix. A firm dollar makes gold and silver more expensive for buyers in other countries, which reduces global demand and pulls prices down. That's 3 forces: forced liquidation, rate hike fears, and dollar strength, all hitting at the same time. Here's what smart money watches that most retail investors miss. It's not the price candle on the chart, it's the mechanism behind the candle. And right now, that mechanism is entirely policy-driven, not fundamentals-driven. That distinction matters more than almost anything else in this video. History quietly tells a different story than the panic headlines suggest. Go back to 1980. Silver had rocketed up in a speculative frenzy, largely fueled by the Hunt brothers trying to corner the market, and then crashed over 30% in a single session when exchanges changed the rules on margin and trading limits. That crash felt like the end of precious metals. It wasn't. Gold and silver both went on to enter multi-decade cycles afterward, with sharp corrections along the way, but long-term structural demand still intact. Now look at February 2026, just a few months ago. Gold hit a record above $5,600 an ounce, only to plunge to around $4,700 within a day, while silver fell 31%, the biggest one-day drop since 1980. Analysts at the time argued this wasn't really about war or safe haven demand shifting. Some pointed out that prices had simply gone parabolic the week before, and once profit-taking started, it snowballed. Notice the pattern. 1980, February 2026, and now July 2026. 3 moments. Same mechanism each time. A rapid speculative run-up, a trigger, margin changes, geopolitical shock, policy shift, and then a violent unwind that looks like the end of the trend, but historically has marked a pause within it, not a reversal of it. That doesn't mean this time is guaranteed to play out the same way, but if history is any guide, sharp corrections after parabolic rallies have tended to shake out weak hands before the underlying trend reasserts itself, assuming the underlying demand drivers haven't actually changed. So the next question is the one that actually matters. Have the demand drivers changed? Let's break down what's actually driving demand for these metals, in plain terms. Gold has always played one role above all others. It's a hedge. When trust in currencies, governments, or the financial system wavers, gold has historically been where capital hides. Central banks have leaned into this heavily. Even now, while central bank buying looks like it's cooled on the surface, more complete data from the London OTC market suggests actual purchases in the first quarter of 2026 increased compared to the previous quarter. Much of it simply isn't reported through official channels. Silver is a different animal entirely. It isn't just a monetary metal, it's an industrial one. About 60% of annual silver consumption is tied to electronics, solar panels, and semiconductors, with electronics alone accounting for roughly 445 million ounces of demand a year. Think about that for a second. Every solar panel installed, every data center built to power artificial intelligence, every electric vehicle manufactured, all of it consumes silver. The ongoing build-out of data centers and rising power demand from AI workloads adds a growth-sensitive layer of demand on top of the investment demand. That's why silver moves harder in both directions than gold. It's not just reacting to fear and safe haven flows, it's reacting to industrial cycles too. Think of gold as a ship anchored to macroeconomic tides, while silver is a smaller boat caught in both the tide and the industrial current. When both currents align, silver flies. When they pull apart, silver crashes harder than gold does. That's exactly what analysts are describing right now. The gold-silver ratio, which tracks how many ounces of silver equal 1 ounce of gold, has been moving as traders unwind rate hike bets, with silver's moves outpacing gold's by more than 1.5 to 1. When that ratio swings sharply, it's telling you something about which force, monetary fear or industrial demand, is currently in control. Here's where most investors get emotionally trapped, and it's worth understanding because it explains almost every headline you're seeing right now. When prices are ripping higher, everyone feels like a genius. Confidence turns into overconfidence, and overconfidence turns into leverage. People borrowing money to buy more, convinced the trend can't stop. That's exactly what fueled the run to $5,000 gold and $100 silver in January. Then the moment a crack appears, a margin hike, a hawkish Fed comment, a stronger dollar print, the same crowd that felt invincible suddenly panics. Forced selling kicks in. And because so many of those positions were leveraged, the selling accelerates far faster than the buying ever did. That's the real explanation for why crashes in these markets tend to happen so much faster than the rallies that preceded them. This is where being informed becomes an actual edge. Most investors are reacting to the headline, "Gold crashes," instead of understanding the mechanism behind it. If you understand that this correction is being driven primarily by leverage unwinding and rate expectations, rather than a collapse in the underlying reasons people buy gold and silver in the first place, you're already ahead of the majority of people watching this market emotionally instead of analytically. If you're finding this breakdown valuable, take a second to subscribe to John A.G. Wealth. Every week, we break down the economic signals shaping global markets before they become tomorrow's headlines. And if this video is helping you see the bigger picture more clearly, tapping the like button helps more people find thoughtful analysis instead of noise. So where does this go from here? Nobody can tell you with certainty. Anyone who claims otherwise is selling something. But we can walk through what the data and the analysts are actually saying. One camp is bullish and sees this correction as temporary. JP Morgan Global Research is forecasting gold to reach around $6,000 an ounce by the end of 2026 and as high as $6,300 in 2027, largely on the view that investor demand has continued to come in stronger than expected and that gold remains a multifaceted portfolio hedge. Another camp is far more cautious. Macquarie is forecasting gold to average around $4,600 for 2026 as a whole, but expects prices to fall roughly 9.5% in 2027 and to keep declining through the end of the decade. Their reasoning centers on inflation and the growing probability of a Fed rate hike, the same mechanism we discussed earlier, just projected forward. For silver, the range of opinion is even wider. Macquarie expects silver to trade around $70 in the final quarter of this year, before drifting down to $65 by the end of 2027, largely because tight supply and strong industrial demand made silver's rally more extreme and therefore more vulnerable to a pullback. Other analysts see the opposite. Some experts argue that if industrial demand for solar and AI infrastructure keeps intensifying, silver is unlikely to ever fall back below $60, given how tight actual physical supply remains. Notice something important here. These aren't wild guesses. They're conditional. Every serious forecast comes down to the same handful of variables: what the Federal Reserve does with interest rates, how the US dollar behaves, whether industrial demand for silver continues to grow, and whether geopolitical tension eases or escalates. If those variables move one way, the bullish case plays out. If they move the other way, the bearish case does. So what should you actually be watching in the weeks ahead? Not headlines, mechanisms. First, Federal Reserve commentary. Every hawkish or dovish comment from Fed officials has been moving gold and silver by full percentage points in a single session recently. Just this month, gold jumped 2.5% and silver surged nearly 4% as traders unwound rate hike bets ahead of the June jobs report, after a softer employment reading and more dovish Fed language shifted expectations. That single data point moved the market more than a week of geopolitical headlines did. Second, the US dollar. When the dollar strengthens, expect pressure on both metals. When it weakens, expect relief rallies. Third, the gold-silver ratio. Watch whether silver is outperforming or underperforming gold on any given move. It tells you whether the market is currently being driven by monetary fear or industrial demand. Fourth, central bank buying data, even the unreported estimates. This tells you whether the world's biggest, most patient buyers are quietly accumulating during this dip. These four signals, tracked together, tell you far more than any single price candle ever could. Here's a question worth sitting with. Given everything we just walked through, do you think this pullback is a temporary shakeout before the next leg higher, or the start of something bigger? Would you be buying this dip, waiting for more confirmation, or staying on the sidelines entirely? Let me know exactly where you stand in the comments below. If there's one thing to take from this entire breakdown, it's this. Price drops in gold and silver are rarely random, and they're rarely permanent verdicts on the metal itself. They're almost always the result of a specific, identifiable mechanism: leverage, policy expectations, or currency strength, unwinding after a period of excess. The 1980 crash, the February 2026 crash, the correction happening right now. Different decades, different triggers, same underlying pattern. Sharp, fast, leverage-driven unwinds that shake out short-term speculators, while the long-term structural demand, central bank accumulation, industrial consumption, currency hedging, continues underneath the surface. That doesn't mean the metals are guaranteed to recover. It means the reason for the drop matters more than the drop itself. And now you know how to read that reason, instead of just reacting to the headline. Markets rarely reward those who react to headlines. They tend to reward those who understand the mechanism before it becomes the headline. Gold and silver didn't fall because the case for owning them disappeared. They fell because leverage, policy expectations, and a strong dollar collided all at once. The real question isn't whether volatility continues. It's whether you'll be reacting to the next move, or recognizing it before it happens. If you found this analysis valuable, subscribe to John A.G. Wealth for more in-depth market breakdowns. Like this video if it helped you see the market more clearly, and drop your take in the comments. And if you want to stay ahead of the next move, check out the next video on this channel, because the next signal may already be forming.